Good morning, everyone. Well, as if navigating an oil major through a rapidly changing oil market, as we've seen the past year, wasn't enough, our next speaker has added to his plate overseeing a transformational $82 billion merger with BG that will create a new Shell in coming years. Ben van Beurden has been CEO of Royal Dutch Shell since January 2014 and has hit the ground running on restructuring the supermajor to rein in costs and improve returns on capital, efforts that have stepped up in earnest as low oil prices make improvements in these areas all the more critical. Today, we have the pleasure of hearing Ben's views on the most pressing issues he sees Shell and the industry as a whole facing in this brave new world of energy. And with that, please join me in welcoming Ben to the podium.
Thank you very much, Casey. So today, ladies and gentlemen, I would like to discuss two major topics concerning our industry and also the connection between them. And these two issues are oil prices, obviously, and on another longer-term level, the transition to a low-carbon future. And let me start with prices. The way I see it, there are four major signposts for oil prices in the short term. That's first of all the economy in relation to oil demand, OPEC, US shale oil, and also capital cost. And what do these four signposts tell us? So the first one is the global economy. Forecasts of global growth are, of course, lower than expected, but demand for oil appears to be robust. Low oil prices, in fact, have stimulated demand, particularly also in developed economies. But elsewhere, however, governments have seized the opportunity to reduce or abolish subsidies, which, while good news, of course, also happens to dampen demand growth. So for this and for next year, the International Energy Agency predicts overall demand to be relatively strong, but again, it looks as if the underlying global economic growth picture will be weaker than expected. So the first signpost, in my view, sends a rather mixed signal. But on the second signpost, OPEC, remains to be seen whether its strategy of defending market share to maximize export revenues will be successful in the longer term. It was interesting to hear Secretary General just now. But despite calls of some members, there are no signs that the leading producer, Saudi Arabia, will change its policy anytime soon. So also here, frankly speaking, no clear hints of higher prices just yet. So what then about the third signpost, US shale oil? American shale oil production so far has been much more resilient financially and more competitive technically than many of us and others had expected. But because a large chunk of loans need to be refinanced actually this month, producers are now looking for new cash to survive. And with WTI prices between $40 and $50 a barrel, they will probably struggle to get it. And moreover, if you look back at May and June, we saw already the first sign of reduced production. So this could entail higher prices. If OPEC, at the same time, of course, can come to an agreement on how to accommodate the aspirations of Iraq and Iran, in particular, to grow their oil production. Now, the fourth signpost is capital cost. And since fourth quarter of last year, capital costs have come down significantly across the industry. And this makes it likely that upstream margins will recover over time, or put it another way, that the industry will reset itself to a lower cost and price level. So to conclude this point then, ladies and gentlemen, I see the first mixed signs of a recovery of oil prices, but with US shale oil being more resilient than we originally thought, and a lot of oil still in stock, we just heard about the overhang as well, it will take some time to rebalance demand and supply. And after this has happened, Saudi Arabia's strategy and the cohesion within OPEC will remain still key uncertainties. So if they get it right and find a new balance, prices will recover, although it remains uncertain, of course, how fast prices will recover and at what level they will settle. But what if OPEC doesn't get it right and prices remain lower for much longer? Then the world may find itself actually in a corner at some stage. When stocks are rebalanced, growth of US shale is stalled, oil production outside OPEC and the US is starting to decline due to cuts in capital expenditure, and when by that time there is unlikely to be any spare capacity left in the system, this could cause prices to spike upwards, starting a new cycle of strong production growth in US shale oil, of course, and subsequent more volatility. Now, either way, companies like my company, Shell, can thrive in this lower for longer world. Since oil prices are great for, low oil prices rather, are great for many consumers and many importers, our integrated business model eases a lot of that pain. And Shell is pulling out all the stops to safeguard our dividends and buyback program and to keep our investment program steady for the future. So to achieve this, Shell is taking a number of steps. And the first step we take concerns our balance sheet, which compares what we own to what we owe. And despite the low oil prices, our gearing ratio, so debt to equity, is essentially unchanged since the end of 2015, or for that matter, since the middle of 2014. It stands at 12.7% at the end of the second quarter. And it reflects, of course, good operational performance, which in turn leads to cash generation, reintroduction of the scrip dividend, and this in turn brings more short-term flexibility to Shell and ultimately, of course, protects our dividends. The second step we take is to reduce operating costs. Operating costs fell in the first half of this year, and we expect them to fall by over $4 billion, or around 10% for the full year. So costs are now back to levels that we saw back in 2011. And costs will go down further next year as we continue to work on the supply chain, on our overheads, and on targeted programs in specific parts of our business. The third step, of course, as many others, is to reduce capital investment. And we expect capital investment for 2015 to be around $30 billion, and that's 20% lower than last year, roughly in line with the rest of industry, but it's 35% lower compared to 2013. Now, portfolio restructuring is the fourth step we take. Some parts of the company have not been performing to their full potential, and in order to improve their potential and their performance, we have specific targets, for example, on cost and unit margins, but we're also taking portfolio actions in these areas, which are now beginning to show through on the bottom line as well. Now, the fifth step, of course, is to sell assets. Typically, these assets that we sell are sold to crystallize value or because they are not critical to our business. This is basically normal business. It's not something that we do only when we need to. The total asset sales for 14 and 15 combined will add up to around $20 billion of value. And the sixth and final step that we take is to continue to deliver new projects and safeguard our free cash flow. Our core business is, after all, built around developing new oil and gas resources. And our project portfolio is geared to increase production, and more importantly, it's geared to generate cash flow from operations and free cash flow, particularly kicking up in 2017 and beyond. So the company is planning for a longer period of low prices. But for the longer term, as I've said on several occasions in the past, I see no change to the fundamental drivers in the oil markets. There will be more people on this planet, more people living in cities, more people buying their first car, first refrigerator, and as a result, demand for energy, including demand for oil, is likely to grow. And in turn, higher demand will need new supplies, and these supplies won't be cheap to produce. New projects are often smaller, technically more challenging, they may carry more non-technical risks, more regulated by governments than they were before, and all these factors are driving up costs that need to be recovered by prices. It's as simple as that. Now, one may think that low oil prices are a real challenge, and of course they are, although our industry is used to dealing with these challenges. But the challenge of low oil prices may pale in the face of the challenges of moving towards a low-carbon future. As I said, global energy demand is growing, so the challenge is how to balance that growing demand with the need to make a transition to a cleaner energy future. And to achieve this, we will still need hydrocarbons for decades to come. I know that some people would like fossil fuels to be replaced by renewables as we speak, here and now. But for technical and economic reasons, this can only happen, of course, step by step. And it will not happen across the board. Sectors like heavy industry, heavy-duty transport, chemicals, they need carbon to operate. And the resource base of other large sources of carbon, biomass, for instance, is insufficient to meet the demand, if we consider only the portion that doesn't compete with food, that is. So this means that sectors like these will continue to need hydrocarbons. And the upshot of all of this, by the way, is that hydrocarbon assets will keep their value, despite what others proclaim. Other people think technology will solve all the problems in the end. And I agree that technological solutions will play a crucial role. In our industry, technology will also be about efficiency, but also technologies like carbon capture and storage, so CCS, are required to clean up the use of fossil fuel. Unfortunately, however, we cannot wait for CCS technologies to mature slowly. The world needs to start applying them widely and without delay. So in my view, the issue is essentially about finding economic ways to invest in an energy transition. And this is why governments should take the opportunity to put a price on carbon. By taking the cost of tackling climate change and air pollution into account, carbon pricing systems will drive the right behavior of both consumers as well as producers. Effective carbon pricing systems would boost technologies like CCS, although more is needed to make CCS a success. Carbon pricing would also level the playing field for renewables, and that would level the playing field for natural gas against coal. Gas is a fossil fuel, yes, I realize that, but a crucial one for building a low-carbon future. Of course, we all know when burned for power, gas produces half the CO2 and 1/10 of air pollutions that coal does. So a switch from coal to gas and power plants improves air quality today and helps deliver a sustainable energy system tomorrow, together with renewables. So in short, carbon pricing systems encourage the quickest and most efficient way of reducing emissions widely. Now, unfortunately, there are concerns that overall energy costs would increase, and these worries suggest a risk that emerging economies will not take part of them, and eventually that would be bad news for everybody, including, of course, our industry. Managing costs for energy users is crucial in making carbon pricing systems work, and here policymakers have an important role to play as well. They need to design carbon pricing systems that address concerns about cost and about competitiveness. And it isn't impossible. In fact, there are some policies being tested to help tackle this problem. Take the tax that British Columbia and Canada puts on carbon, for example. It's revenue neutral. Revenues must be used to reduce other taxes. This basically means that the government compensates carbon taxpayers by lowering other taxes they have to pay. And the second example is here in the European Union. Its emission trading system involves a risk of carbon leakage. And this occurs when companies move production to places with fewer carbon constraints, potentially then, of course, leading to more emissions elsewhere. So the EU initially gives sectors and subsectors with a significant risk of carbon leakage more allowances to emit CO2 than others to keep them within the emissions trading system. So ladies and gentlemen, I believe now is a very good time to promote carbon pricing systems. In only 2 months, the UN Climate Change Conference, COP21, will be held in Paris. And in cooperation with 5 other energy companies, Shell has sent an open letter to the parties at COP21 and has established a paying for carbon initiative. We ask governments at COP21 and beyond to introduce carbon pricing systems where they do not yet exist. And we also ask them to create a framework along the lines proposed by the International Emissions Trading Association that could connect all these national systems or regional systems. Because if we get them right, carbon pricing systems could really reinforce the transition to a low-carbon future. So just recently, China announced a national scheme setting a price on carbon. So I believe the momentum is there, and I hope we all will seize it. So I know it's a tough time for many of us. The abundance of oil on the market today is putting pressure on our industry. And although the future may look brighter than the present, we could even consider calling this gathering today the More Oil, Less Money Conference. But we shouldn't let today's oil prices blind us. Even more than prices, a transition to a low-carbon energy future will shape the destiny of our industry over the coming decades. And this demands our undivided attention. I'm not Alice in Wonderland, the UN lead on climate change, Christiana Figueres, recently said to a reporter. She said, "You and I are sitting here in this gorgeous apartment," I don't know where it was, "enjoying this fantastic privilege, all because of fossil fuels." In other words, for so long, through times of high and low prices, our industry has been a partner in progress. So let's keep it that way in the future. Let's help create, with a nod to the theme of this great event, a brave new world for energy. Thank you very much.
Thank you very much for that. I want to follow up on actually one of the points you made toward the end of your speech about seeing momentum in place for carbon pricing systems. How do you see Shell and the industry at large being able to be that partner to move these schemes forward? What's your place at the table?
I think we have a number of places at the table. First of all, I think we have a place to advocate. I do believe, as I said a number of times before, that we have been way too absent from the debate. And as a result of it, the debate has been shaped too much by voices that may be not as well informed about some aspects of the energy system like players than we are. But also practically speaking, yeah, I think we do play a role in the debate. Take, for instance, the shaping and the evolution of the emissions trading system in Europe with the Market Stability Reserve. A very, very significant part of that shaping was done by companies like ourselves. A few years ago would have been sort of impossible when we were talking about the set-asides. But eventually, if we get in with sort of sensible advocacy, explain to people what it means, how it can be done, maybe the pressure and the objections against it will recede, and ultimately things like this do get implemented. So yes, I do think we have a role to play, both in terms of high-level advocacy, as well as in terms of sort of practical suggestions.
Mm-hmm. Can this advocacy be truly effective if some of your top peers continue to strike their own way?
Yeah, I think it is. I think the previous example that I just mentioned is actually a good case in point. I do not necessarily think that we have to be completely joined up within our industry, the narrow definition of our oil and gas industry, in order to make valid points. In every dilemma, in every sector, in every transition, there will be leaders and laggards. I'm perfectly okay to be part of the leaders. And ultimately, I do not think it's just the oil and gas industry that has to join up and advocate. I think we have to have a much wider advocacy of participants in the broader energy system, be it utilities, be it NGOs, be it academia, to make the point, a coalition of the credible, so to speak.
Mm-hmm. Yeah. That makes a lot of sense. Could the low oil price environment actually help some of these carbon pricing mechanisms gain traction since the general cost of energy has fallen? Or could it inadvertently hurt in some cases because of the demand uptick we've seen?
Well, I think price volatility is a effect of life. The fact that we haven't seen it for a little while is probably a little bit of an anomaly. Mm-hmm. So we just have to accept that we are in a commodities type of industry. Prices will go up and down. Okay, it may be rather violent at this point in time, but I think volatility will stay with us. And systems will have to be designed to cope and withstand that volatility. That's just the reality of life as well. If we have a system that only works with fair weather and not in rough weather, then ultimately it doesn't do its job. Mm-hmm. And I do think that there are mechanisms and ways in which we can do that. Mm-hmm. And governments can do it as well.
Makes a lot of sense. Well, speaking of volatility, Shell and the majors in general often speak of your multi-decade investment horizons, but that doesn't mean that short-term pricing trends don't impact your strategic decisions. So how has the volatility rather than low oil prices per se kind of challenged those efforts?
Well, I think you have to you have to distinguish between our long-term sort of fundamental strategy, which is very much aligned with the fundamentals of the market as we see them, and the short-term price volatility, which basically sort of drives affordability of investment decisions. These are in a way two different things. So yes, of course, we also have a very, very simple approach to our cash flow balancing. What goes out must eventually also come in, or the other way around. So therefore, the pace and the rate with which we, and the schedule with which we make investment decisions, of course, is dramatically impacted by what we see in the market. But it doesn't fundamentally change the direction of the company. The direction strategically is fundamentally set by the fundamentals of the market. And of course, we have to deal with the realities on a year-by-year basis.
Makes a lot of sense. Well, this is kind of a step back a bit, but does the slower, kind of more disciplined investment pace that Shell and the majors are now pursuing portend a smaller future role for you in the global oil supply mix than we've seen historically? And is that a transition we perhaps would be seeing anyway as more investments move to gas?
I think oil and gas, of course, are slightly different in the sense that they also serve by and large different markets, mobility versus sort of thermal, if you like, if you keep it very simplistically. I think both very important components for integrated players like ourselves. Maybe this is not the right venue to admit that we are more a gas than oil company, but that's the reality, and many players are moving in the same direction. No, I think by and large, oil and gas demand will see a significant growth for years to come. Of course, we are perhaps scaling back investment levels at this point in time, but probably in line with the industry at large, with some classes of assets probably being held back even more vigorously than the sort of holdbacks that we have. If you look at US onshore, of course, we're seeing much more vigorous cuts in capital spending than you see across the board. With our 20% compared to last year, I think we are pretty much in the pack, as probably are many of the other IOCs.
Yeah, that makes a lot of sense. Well, with that, I would like to open the floor to questions. If you could say your name, your affiliation, and then try to make your question direct so we can try to have as many as possible as the time allows. So.
I think there was one there.
Sir. Yes.
You mentioned this initiative of a few large oil company, open letter, asking, in fact, for a carbon pricing mechanism. Apparently, the list of the companies were all European, if my memory is right. What was the difference of approach from the US oil company? Was it more on principle or interest different, or what was the rift between the two?
Yeah, I think the only sensible answer I can give to it is you have to ask them. We did have a discussion, by the way. We of course, felt that this would be more powerful if it would come from a wider range of industry players. They had their own reasons for not wanting to be part of this particular one. I think some of them very well articulated by the CEOs of those companies. Which meant that we had to move forward with the group of players that we had. I think it is a very important statement to make. But as I said also in response to Casey's earlier question, I think we have to broaden the coalition by which we talk about climate change, the transition in the energy system. It is not an oil and gas company's area. This is very much also, of course, the domain of utilities, the domain of regulators for that matter, the domain for academia and NGOs. So we have to have a much broader discussion because it is such a complex area. The whole suggestion that this is actually pretty simple, there's a silver bullet to it, actually it does more disservice to the whole problem than the acknowledgement that it's a complex area where a number of players have to lock arms and work together.
Yes, right.
Thank you, Javier Blas from Bloomberg. Let me say first, congratulations for Energy Intelligence for another fantastic lineup on the conference. And to Ben, you sounded today relatively more upbeat than I have heard you in the past few months, saying that you see first mixed signs of a potential recovery in oil prices. Does that change your outlook, how you are preparing your strategy for 2016? Do you leave room for going up in capex, or do you still think that you need to be very conservative, prepare for the worst, and hope that actually prices recover? Thank you.
Thank you. Yeah, maybe if I sounded unduly bullish, I should maybe perhaps put that back into the box again. No, I think that we will see mixed signs, and we will see mixed signs for some time to come. But I do think if you look at these four fundamentals, and if you would sort of extrapolate a bit further along, bearing in mind that ultimately the oil price is going to be set fundamentally by the marginal cost of non-OPEC supply. Well, you have to believe in higher oil prices than what we see today. But you cannot wait for these higher oil prices to help you today or tomorrow or next year if they are not there. So no, we are preparing lower for longer, and we are very much sort of planning with an affordability lens. How much capital can I afford to lock in? If I lock in a project, how robust could it be in that lower for longer world? And what happens if oil prices completely reset to much lower levels? Is this particular investment going to be resilient in that world as well? So that is the lens that we take at the moment, and that will drive the pace of our investment decisions. And I've said very clearly, if we see today's oil environment or price environment by next year, yes, we will be looking at lower investment levels, about $35 billion if you look at the two companies, Shell and BG combined. So no change in that respect.
Yes.
Hi, Farid Jafarov, State-Oil Company of Azerbaijan. To continue on what you just said, and I'd like to compare your view of your company on the view of the previous speakers, they have sounded some quantifications on the expectation what would be the impact on the supply-based erosion of the current price level. So I'd like to hear, if possible, what's your view? If today's price levels are there to remain for the prolonged period of time, do you have any quantitative estimates of what's going to be the result of that in terms of the supply that the industry is having today?
Well, I think that is probably better left to the previous speakers to quantify. But fundamentally, yes. You know, if you look at what is happening in the market, what is happening in the market all the time is we do see a growth in demand. You can argue how much that is going to be next year, but let's say for argument's sake, 1.5 million barrels a day. And we do see, even more importantly, a continuous shrinkage of supply. Now, how fast supply will shrink, depending on the oil price, you can argue about. Let's sort of peg a number at 3.5 million barrels a day. So that means 5 million barrels a day of new supply needs to come on this year, next year, the year thereafter, and maybe a little bit more or less, depending on how fast the erosion goes or how quickly the demand will pick up. That 5 million barrels a day is ultimately going to come from much more significant investment programs than what we are currently sanctioning. Today's 5 million barrel a day, or this year's 5 million barrel a day of new supply will come on from investment decisions that we sanctioned as an industry a few years ago. Yeah? What will come on in 2018 will be the result of what we are sanctioning this year and maybe last year. And of course, that's a fundamentally different picture. So ultimately, yes, I think previous speakers were also right in pointing out, and as I said myself, if we see too much of this for too long, and if we do not play this carefully as an industry, then of course, yes, you will see a significant spike up in price again as the market gets very, very short. Ultimately, nobody will be served by that, because ultimately it's the lack of sort of forward visibility and consistency that will drive rather erratic behavior, which is not in the interest of producers and also not in the interest of consumers.
Amir Paivar, BBC. Since Iran is back on the agenda and Shell was accompanying Foreign Secretary Hammond to Iran, can you please tell us what exactly you're discussing with Iranian officials at the moment, and also elaborate on the, of course, everything after the sanctions are removed, we know that, and there's a comment about, from an Iranian side saying that the Shell has been granted permits to build petrol stations in Iran.
Oh, thanks for the news update. I hadn't heard that. Well, as I said on previous occasions, most of the discussions that we are having with the Iranian authorities is, of course, about the payable that we still have to NIOC from before the sanctions regime. At the moment, there is not an awful lot to discuss. Of course, Iran is a very sort of interesting country if you are in the oil and gas industry because of its geology. It holds potentially a lot of interesting promise and perspective. But we have to see how that market will develop, what sort of terms and conditions will be posted. We'll have to take a view on our appetite to invest in general, and particularly also in the sort of the resource base and the general country risk. And I would imagine, we are in that sense not alone. Everybody will take that view. I think at this point in time, it is extremely premature to say anything about how that outlook would be. Let's first of all see how the terms and conditions are.
Okay, with that, we are actually out of time. Sorry.
In energy intelligence, since we have moved to various regions, I would like to ask you a question about Russia. Do you see any opportunity for Shell in sanctioned Russia?
In sanctioned Russia?
Yes, what I mean is that maybe you have refocused on conventional onshore projects, which Russia maybe is more willing right now to offer foreign partners.
Well, of course, our interests in Russia are substantial, and we, of course, believe with many others that Russia is an incredibly important country as a resource base for gas, for instance, for Europe, and for oil more worldwide. Of course, there are areas that are sanctioned, and we will not and cannot operate in there. That's pretty straightforward. But it doesn't mean that there aren't any other opportunities to invest. At the moment, we have a very attractive and very strategic collaboration with Gazprom in a number of areas, including in the Far East in LNG, exporting gas into predominantly North Asian market, Japanese market. Very strategic project for a number of reasons, including geopolitical reasons. That is still an area where I see a lot of scope in other areas as well. So let me again reiterate that we will of course obey with every and any sanctions that are there, but it doesn't mean that there are no opportunities to invest. And at the same time, we'd like to take a long-term view on things as well. And there is no denying that Russia will remain an incredibly important player in the oil and gas industry for many decades to come.
And with that, we are out of time, but I want to thank Ben very much for your very thought-provoking speech and a very thoughtful discussion. I think one takeaway I have is perhaps moving forward, we should name the conference Oil and Money and Climate. So thank you very much.
Thank you. Thank you.